Hello guys, today we're going to be reviewing section 3.3 of IB Business Management. A really simple and easy section. So we're just going to be talking about costs basically. So let's begin by defining a cost. So a cost is an expenditure amount paid by the business to produce or sell a good or service, including the acquisition of business resources. So basically what the business pays. So now we're going to be talking about the different types of costs, which is what's really important. These are actually frequently asked about in the definitions, which are basically two markers, so easy points. So this is done in order to really get and attain as much points as you possibly can to score the highest marks possible. So let's begin. So you have a fixed cost, a cost that does not change with the amount of good or service produced, meaning that whether you produce 5 or 50 of good X, you're still going to have the same costs. So what are fixed costs? Fixed costs can be rent because you're renting the same building. So no matter how much you produce, it's gonna still be the same. It won't change. The expenses have to be paid regardless of any activity the firm engages in. So basically, if you produce one good or 50 goods, you're still going to pay the same amount because again, it's a fixed cost. And examples include rent, insurance, and salaries. So salaries basically the amount of employees, and insurance and rent basically. Variable cost is the exact opposite of fixed cost. So basically, it's a cost that does not change with the number of goods or services produced, meaning that if you produce, basically, it's the cost of each unit produced. So whether you have you're producing a company that produces shoes, the more shoes you produce, the higher the variable cost because the cost of producing each shoe is, let's say, $12. So with each shoe you produce, you pay extra $12 in your variable costs. Now there is something called economies of scale, but for now we're not going to focus on it. Past paper definition. So this is from a past IB paper. So this is a good definition to know. Variable costs are costs that vary in direct proportion to change in output level of production, meaning the more you produce, the more your variable costs. So once production rate increases, variable costs increase. Once the production rate decreases, variable costs decreases, which is why it's again in direct proportion. So we're just gonna underline this. There are expenses that change in the proportion to business activity. Variable costs are volume related as they are paid per quantity produced, exactly like I said. Examples are raw material costs, cost of sales, cost of packaging, and energy usage costs. So for example, energy usage cost is because, for example, the machine is operating more, it's operating for a longer period of time, it's using more energy, so that's why it's using more electricity. The cost of packaging each box produced to put the shoes inside. So yeah, so total cost is fixed cost plus variable costs. So usually you have the total cost, which is just a number, and then you have the variable costs, which is basically, if you want this to be easier, just like this is like just any number, so we're just gonna leave it. But variable cost is usually VC, which is variable cost times quantity. So it's something like that. I don't want to keep it because it's a bit weird, but basically this is just this doesn't change, but this changes. That's what I'm trying to say. So direct costs are basically costs that can be identified with the production of a specific good or service. So they are expenses which can be traced back to a particular product, department, or process. So for example, the marketing campaign can be traced back to the marketing department, or for example, a certain fabric can be traced back to a certain product, like a certain shoe. Examples: raw material, direct labor, and packaging costs. Indirect costs are overhead costs, like they're the same definition, but they're the same word, they have the same meaning. So they are costs that are not clearly identified with the production of a specified good or service. So this is basically electricity, maybe, insurance. So there are costs which are not directly traceable to a given cost center, such as product, activity, or department. So again, direct and indirect, they're kind of opposite meanings. So rent, you have rent, insurance, audit fees, legal expenses, security, and warehouse costs. So for example, you're still going to be paying the same rent despite that certain cost. So yes, despite how much you produce, you're still going to be producing, you're still going to be paying rent. Then you have revenues. Revenue is the amount of money earned from the sale of goods and services. Revenue is basically price times quantity. Total revenue is the total amount of money a firm earns by selling a good or services. Revenue stream. So this is basically from a past paper, but revenue streams are referred to the different sources of sales revenue that a firm may have. So they may generate revenue from different sources in different ways, meaning often a firm grows when they attempt to diversify revenue streams as a way to find sales growth in saturated markets or a way to offset risk. Meaning that, for example, I'm going to be using the business bond. Okay, so if you're a 2024 student, you know what it is, but basically it's a company that creates film festivals. They offer that service, but they also make money through sponsorships, for example. So these are like two different ways. So businesses, they make money through sponsorships. Sometimes they make money through different ways, which is why they have different revenue streams, which is a plural word. So you can tell from that. And it's also a way to offset risk because, again, if one stream isn't generating revenue, then they have the other. If sales revenue from one revenue stream declines, perhaps it can be offset by sales growth in other revenue. That's what I just said, but basically. So revenue streams for business include rental income, sales of fixed assets, which we talked about, and how fixed assets can be used as collateral. So they can use unused assets or assets they're not using as much, which are underutilized. Dividends, we talked about that in unit 1, where basically dividends are paid to shareholders, but they can withdraw from giving them dividends, or this is when they actually buy shares when the company is publicly limited. So yeah, it's a public limited company, so they can make money from people buying shares on the the stock exchange. So sorry. Interest on deposits. So holding a substantial amount of cash in the bank can lead to business earning good levels of accumulated interest on the money if the interest rates are favorable. So basically, if the business has money in the bank and there's like a 3% interest, they can be making profit off that. They can be making money off that, and they can be making donations if it's a certain amount of company, because we know that there's from section 1.2 that there's different types of companies. You have some charities, but these are not really businesses, but they are a type of business, but yeah, but they're not a company. Or for example, you have those that provide physiological needs, so they take donations. So it really does depend on the type of business that you're talking about. So it can be a like non-profit entity, profit entity. So yeah, that's basically it. Thank you so much, guys, for watching. As I previously mentioned in my other videos, that I will be opening a IB tutoring business soon. The website is launching soon. It's called IB Excellence Academy, where I'll be doing crash courses for the whole entire IB business management units. And this is it. Thank you so much, guys, for watching. The links will be posted soon, but I will post a link for my Google Classroom in my description so you can stay in touch. Thank you so much for watching. Bye bye, guys.